Obviously, private ABS and debt covers a wide array of asset types and strategies, and with me here today to illuminate those are a all-star panel, and I'm going to ask each of the panelists just to briefly introduce themselves and their platform, and then we'll get into some questions. Nelson, do you want to start?
Sure. Good afternoon, everybody. Thanks for coming. My name is Nelson Chu. I'm the founder and CEO of Cadence. We are a securitization and investment platform for private debt. And so on the investment platform side, we have a retail platform available for accredited investors in the United States to give them short duration, high yield, low minimum investment opportunities in private debt. And so that is basically 1 month, 3 month, 6 month investments, all in the range of 8 to 12% with $500 minimums to start. So that applies to everyone in this room. You can feel free to sign up and you can see what we're up to. As these originators that we work with grow up, we actually have an institutional securitization side of our business. We were out to market with a public company whole business securitization, $40 million deal. And so our capital markets team is responsible for being the structuring consultant in those types of transactions.
Scott.
Hi, Scott Rosen. I'm a managing director at Ares Management. Ares is a $150 billion alternative manager focused on private equity, real estate, and credit. As part of our credit business, we run a large $14 billion alternative credit practice where we focus on providing warehouse financings, both rated and unrated, and securitization structures, and also all forms of other what I call creative capital to the alternative credit universe. Think of all the holes that traditional funds don't play in. That's exactly where we are trying to play.
Hi, I'm Noelle SPROUL, and I'm a managing director in the legal department of Nuveen. Nuveen is the asset management subsidiary of TIA, and as of year end, we had approximately $1.1 trillion in assets under management. I primarily support the Nuveen's private market team, and I focus on private ABS and other structured products. We have expertise across the spectrum of asset classes, but we are known for our alternatives business.
Thanks, Noel. I'm Michael URSCHEL. I lead the specialty finance team at King & Spalding. We're a law firm with 21 offices around the globe. Principally, we're active in securitization and esoteric assets and the whole business securitizations, wireless towers, ground lease securitizations, data center securitizations. Principally, we've been active in the 144A space. We've been doing more and more in the 4.2 market, kind of creating hybrid 4.2 products for some of the issuers and some of the investors in the space.
Thanks. And for those of you who came to our panel, I think you made the right choice. I think this is an area where you're going to see tons of activity. And just to start it off, I want to start off with a true-false question for the panelists, and it really revolves around the role of investment banks in the private ABS, private debt space. And the question is, the future of private ABS and debt involves a prominent role for investment banks as admin agent and placement agents. Is true or false? Nelson, why don't we start with you?
I think that's still true. I think there is a role that these investment banks do play that's actually pretty important. And having gone through the process ourselves, I think the role of a placement agent and someone who's, for example, bringing a first-time issuer to market, as much as there is a lot of appetite and demand from the buy side for these opportunities, it's still a very difficult game to play to kind of get all these deals done. And so the investment banks have played a crucial role, and I do expect them to continue to play that role in the future.
Scott?
I think it goes to the company and what they're trying to achieve. On one side, investment banks keep people like me honest, right? You create competition, you have 15 people bidding, you get to the market efficient price. On the flip side, what you're seeing today is large asset managers have taken over the place that banks used to play. So at Ares, for example, I can do a $20 million deal, or we can lead $1 billion transaction. So the idea to go to a company and offer a one-stop shop where they don't need anyone else, there's a lot of costs and efficiencies that can be brought out of that, but it doesn't work for everyone.
Yeah. Noelle?
True. So the private placement market, it's relationship driven. So it could be the relationship with the placement agent that we have to source deals. It's also our relationship with the issuers. We do have the ability and expertise to do it without placement agents, but ultimately we want to partner with agents and issuers to provide solutions for their capital needs.
And Mike, true or false, but also are you seeing any trends on your side with the role of the investment banks in that process.
Yeah, yeah, I'll definitely say true, and I represent a lot of banks, so I will not hide that fact. But the important thing is, part of this entire market has been based on innovation, and the banks, I think, will always be a source of innovation and new ideas in the space. But in particular, if you think about some of these large companies, especially in the telecom or similar industries, where they may have several different pockets of their capital structure. They may have a holdco revolver. They may have an unsecured bond offering. They may have a privately placed securitization done with with an insurance company. They may have a 144A deal in a separate silo. As their capital structures get that complicated, and there's different pieces where different relationships are needed for different pieces of capital, the banks can provide a key intermediating and key relationship and structuring advice there.
Scott and Nelson, we talked about the interest level in this asset type. I mean, one of the things we see at the firm is, just consistently asset management platforms saying, notwithstanding the number of truths, we're disintermediating, the banks. We'll do these facilities on our own. What's driving all the interest, though, in this space right now?
Look, the honest answer is I think you see a lot of people in the corporate world. It's gotten pretty tight out there, and people are looking for yield. And this is a place where you can get contractual cash flows or asset values. It can get very, very complicated, but you're seeing a lot of people attracted to the space because the yields are there.
Nelson?
Yeah, I'd agree with that. I think, we're at a stage where the yields have been low for so long that you're not going to get it in other places, and so they're looking to different avenues to kind of get the returns that they've been expected to deliver on. And so I think the difference is now, though, that there's probably a more expectation of transparency around performance, around data of the underlying assets. And so there is demand, but it also comes with an expectation of, an ability to track performance in a much better way than they ever could before.
I also think lastly, just you saw through the financial crisis, irrespective of underwriting, but you saw that the structure did what it was supposed to do in a lot of cases, and when it didn't, it was because the equity guys snuck something into the structure that no one paid attention to.
Now, obviously this is a very broad space that kind of, covers all the areas of, the ABS market in general. What areas do you kind of find particularly attractive and challenging in this market?
I think for us, we are pretty diverse in the asset classes that we cover, and so we do small business lending, we do factor receivables, we have assets that we season, we have consumer loans, and so in all the space that we work with, I would say the ones that are the most attractive and the most interesting are also probably going to be the ones that are the most challenging coming up, especially if we're heading towards some sort of recession that may or may not come, but probably will come. And so we are looking at SMB loans as probably one of the most attractive right now. MCAs have done very well for the last couple of years. It's been a very attractive asset class. The returns have been there. But at the same time, that probably will be the first to go. I think there's been a lot of loosening of credit standards to be able to actually take more and more of these, offer more and more of these loans to these small businesses, and the businesses have been more than happy to take it. But it will be a very challenging environment should everything start to be pared back, and we would expect, honestly, more of a flight to quality, more to be asset-backed and less asset-based in the future as the market starts to turn.
Scott, how about you all?
I'll be honest, we look at every single alternative credit asset class there is. I think life settlements is probably one of the few ones we won't touch, but besides that, everything else we're involved with. I think the question to us just goes to where should we be playing it? We can do structured equity preferred, or we can do the warehouse, and look, we're at the end of a cycle, so right now you're seeing us do a lot of first lien lending where maybe we use leverage to get to return because at some point things are going to get worse, but we pick and choose our spots. I'd say for us it always comes down to the quality of management before the asset class, though.
Got it. Now, Noelle, quality of management, but there are other considerations that come into play at places like Nuveen and obviously Ares, big shops where ESG is also a factor. How does that overlay into some of the analysis?
So TIA and Nuveen, we're leaders in responsible investing. We have more than 5 decades of experience. You can go online and find our policy statement on that. As of September 30th, 2019, we had approximately $25 billion in ESG-focused strategies available, but all of our firm assets are committed to the UN principles for responsible investment. ESG gives us an additional lens to use when assessing a company's performance. We have a proprietary tool that's integrated into our underwriting process. The results of that tool inform our comfort level with the underlying company or collateral, and it's absolutely built into our credit analysis. Whether a particular investment is compliant ultimately depends on the demands of our investors, but ESG is always part of our analysis. We firmly believe that integrating ESG into the analysis and diligence enhances long-term investment value for all of our investors. Sometimes our investors, tell us what to do or what not to do, and we're guided by them, but we still use the lens and the tool.
Now, Nelson, one of the hot topics at the conference in general has been macro themes, election, Brexit, coronavirus, you name it. How do those types of macro considerations affect the private ABS space, private debt space, or is it just depend on the asset type a little bit?
Yeah, I think it does depend on asset type. I think everyone who works in private debt, especially on the more retail platform side of things, will tell you that it's uncorrelated alpha. But I'm going to be the first to tell you that if the market goes south, those assets are also going to go, a lot of them at least. And so if the uncorrelation part is really not necessarily completely accurate, but there's certain parts that definitely are. I think general macro sentiment will affect these underlying assets. I mean, the borrowers themselves, I think the good ones will remain, and actually those will probably be the best vintages. I think I remember in 08-09, a lot of the lenders in that time frame, when the banks stepped back, say that 08-09 was their best vintage, right? It was actually the best performing, and it's because the high quality borrowers that lost their lines of credit now had an opportunity for non-bank lenders to step in and support them, and they've all done really well and paid back really well. I think when you have the lower quality borrowers who are kind of taking advantage of the situation, those guys are going to be in trouble, and those lenders who extend capital to them are going to be in trouble. And so that's really what it comes down to. I think macro does definitely play a role, but it really will be heavily asset class dependent.
So Scott, you said 150 billion platform size. How do you kind of feed the beast, if you will, and how difficult is sourcing the opportunities in this space, and in particular, do you shy away from like new, really, untried or untested assets, or talk to me about the sourcing of opportunities here.
I'd say the most important thing that we've learned through the years is that the best origination channel is your existing portfolio. So what we've found is that we do $20 million deals despite the fact that we manage $150 billion, because if we do that and the company grows, it will keep working with us, because once you find a lender relationship, you'd rather stick with them if you get along, especially if they can grow the size of the loan to you and or change the cost of capital. So we play with deals where we're the direct lender, we then take it to a club, we go on the right or the left if it's a syndicated deal, but you stick with people you know. Outside of that, we have a number of originators across the platform, across strategies, where we're calling on, I think, every single private equity sponsor with north of a $500 million fund in North America and Western Europe. We talk to every single investment bank. So the answer is we hustle because for the most part in our business, specifically in the private credit piece, not the liquid credit piece, we are creators of credit. We're not buyers of credit. We work directly with companies to solve whatever problem they have in front of them, which might be the problem is they want capital to grow. It's a good thing, but we help solve that. We don't just fill a hole that someone else told us to buy.
Noelle, how about you all? Global platform. I thought what Scott said is interesting. Creators of, of capital and creators of solutions. I mean, that's what I think is one differentiator on the private ABS debt side is, they're really solving problems, not just kind of putting things in particular boxes. But what about your sourcing channels?
So our answer is not very different from his, but again, I talked about the relationship before. We're relationship driven. We do look to our portfolio to create relationships in the private space or other parts of Nuveen. We are a credit shop. And we have deep expertise in a variety of asset classes. And so we build relationships with issuers, with placement agents, with those who have capital needs. We perform our underwriting analysis, and then we want to create solutions. And we can do that directly, we can do that with the agents. We don't shy away from the difficult asset classes. I mean, honestly, if it passed our underwriting process, and we believe that the cash flows and the manager is solid, then we are willing to do that work with the issuer and the placement agent and get there on challenging deals. We like those deals. Our investors like those deals.
Nelson, how about yourself in terms of the sourcing? You have a slightly different platform. Any interesting differences between the way you all source opportunities?
Yeah, I think we play in a different side of the market, right? So I know that you guys do $20 million deals, we will do $100,000 deals, so it's a little bit different. But having said that, there is a tremendous opportunity there to find these up-and-coming originators, right? So these are guys who have $5 million portfolios, who are tech-enabled, and that actually is probably the most important piece to all this for us. We wanted to make sure that we can integrate and capture their data coming out of their systems in order for us to be able to do better underwriting on our side, so we can deliver that back to the investors as well. And so it kind of goes hand in hand. So as we take this data in, ingest it, standardize it, normalize it, we understand exactly how these up-and-coming originators are growing. And they can grow very nicely through our retail platform until the point where they're ready for term securitizations, and then we are there for them as well. So it is still very much relationship-driven, and we've been there for them every step of the way since a very early stage, and so we hope that they continue to stay with us in the future. So from a sourcing side, I mean, look, we have, let's see, we started with small business lending, and we very quickly got to factor receivables, and then we started doing solar financing. So, as people come into us, as long as there's contractual cash flows, as long as they are data-driven, tech-enabled, we will work with them because there's a tremendous opportunity in front of us to help them grow and scale on their terms.
So Noelle and Mike, now that you've got the opportunity sourced, one of the big differences, I think, between the private ABS credit side and bank ABS is you got to diligence it. And no one's there to just say, okay, we've done all the diligence, you're fine. What process do you use when you're diligencing these types of transactions, and also where maybe it's a novel, it hasn't been done in a rated transaction, or it's just a novel asset?
So the diligence is a collaborative process. We work with our outside counsel. If there's a placement agent, we work with them. Of course, we work closely with the issuer. The contractual cash flows have to go through our underwriting analysis. We have to know that they're there. We have to be comfortable with the manager. That's all on my business team. On the legal side, we have developed a template that is constantly evolving as we learn from new asset classes. And so I try to provide really consistent legal analysis and structures. This helps us spot issues earlier. Again, we're in a relationship with the issuer. So the earlier we can bring those issues to bear, the easier it is on the long-term relationship. We want to understand the risk of the particular collateral, any market practices, anything unique to the structure because of the issuer, the manager, or the collateral, and we proceed accordingly. We want a structure that we hope protects the downside risk of our investors while also working to create a solution for the issuer.
Mike, you get a call from Noelle, new deal, new asset type, what starts going through your mind?
Well, exactly, and I was going to make the point that there's three flavors, and that's the second flavor, by the way, in private placements. And, those of us who are mostly accustomed to securitization, we're used to either doing a 144A securitization where you've got an underwriter or a placement agent putting together disclosure materials, or we're used to representing a bank where they're doing it on their books or as a warehouse facility where they do their own diligence. In private placements, there's really a couple of flavors. There's the flavor where Noelle or Chris calls directly and says, hey, we're going to do a deal for this particular issuer. We're going to take half of it, and we're going to bring in somebody else to take the other half, but we're very focused on documentation and diligence. There you get to talk to Noelle early, find out what she's interested in, find out what she wants to look at, tell her in this asset class, maybe she hasn't seen it before, here's the 5 different kinds of collateral deals you're going to have, and here's why you need to care about the following 4 things. That's the classic private placement, and then they're literally negotiating on a bilateral basis with the issuer. The other private placement, which is the more hybrid between a 4A2 and 144A, is where a placement agent goes and says, okay, we've got a deal we're going to do for this issuer. We're going to sell it to the insurance companies. There might be 10 to 15 of them. You're not going to know who they are until we price, but we're going to do it as a 4-2 because we're not going to have an offering memorandum because it's a new kind of asset class. And that's probably the more challenging one from a diligence and documentation perspective, because I may not know that Noelle's going to be a client until 2 days before we price, right? So you need to know the universe ahead of time. You need to know what they're going to care about, and you need to have an issues memo prepared that they can review on a quick basis and understand what they're getting into.
So Mike, I'm just going to say, you better get me that diligence memo more than 2 days before we price, because remember, I read the documents, and my business reads the documents, because we are there. But Mike raises an interesting point about the various flavors. We are frequently, more often than I like, in deals where we are creating a new relationship with an issuer and a new relationship with counsel. And that is harder on our process internally when we are not sure that the counsel that's been designated to represent investors knows the issues of the 4A2 market and knows that 4A2 investors look at and comment on documents. A lot of times, we have counsel that's usually only in the 144A space, and it can create a lot of tension for us on the team. It makes the analysis harder because I'm not going to say we comment on every deal, we don't, but we want to make sure that we have a structure in place that works for our investors, and so we look very carefully at the documents.
Yeah.
No,
That's really the key point in this space is that, you know, when you're doing a 144A, you've got an offering memorandum, you price, you close. You don't typically get direct comments from investors other than that they have some specific stip for their order. Here, you know, both for securities law purposes and diligence purposes, it needs to be individually and directly negotiated, and you need to give the investors the time to do that.
Noelle, you mentioned you know, templates and familiarity with the law firm. How important is it, you know, to have, you know, people that know what, you know, the Nuveen, you know, process and what's important to your investors? And because one of the things I've seen in this space is sometimes, you know, there's a reflexive reaction of, oh, well, we'll just reach out to whoever's, you know, did the last aircraft ABS deal, you know, just to use an example. But that may not really be the best fit for a private ABS or private credit deal if they don't know.
Right. I'm going to say my preference is that counsel who's designated for investors, well, I prefer to know them and know them well, but when I'm not in that situation, which is frequent, I prefer them to have expertise in the asset class and either knowledge of 4A2 and how we work, ACIC, the model form, some of our concerns, or a willingness to learn. I'm going to be honest. I don't always see the immediate willingness to learn. We sometimes see condescension and pushback when we make comments and kind of negotiate, and it makes things a little bit more difficult. So I have a list that I draw from, and that's who I would like to see over and over again. And you know, personally, from a personal perspective, if it's somebody that I don't know, it's a lot more work for me, which means that I can do less deals for my team.
Now, Mike, you were talking about 4A2 and 144A and the distinction there. Does that also have implications for risk retention and some other factors? And you know, what else does that impact in the structuring the transactions?
Yeah, so, you know, so on risk retention, it's at the end of the day, it's still an asset-backed security, so you still have to comply with risk retention. But, and so we're still getting the same kind of standard risk retention memos and other things that you'd get. But the key difference for documentation, and Noelle and I were talking about this as we were prepping today, is a lot of the private placement investors, they come from the world called the ACIC world, which is the classic private debt placement market where people are, you know, placing either secured or unsecured notes to investors. They're not securitizations, they're just private placements and notes. And they have a form called the ACIC Model Form Note Purchase Agreement, which is the form document that they issue the notes on and they buy the notes on, has all the covenants and the various provisions in it. Securitizations, as everybody knows, we've got an indenture or we've got a credit agreement. So a few years ago, we were working on a transaction. The first thing we had to do was figure out, okay, what's in the indenture? What do we want from the ACIC model form? And we need to come up with a customized NPA to preserve the ACIC provisions that the investors care about, but also give the issuer and the placement agents, an indenture that looks like what they're used to and they're used to complying with. And so that's kind of the interesting piece at this point, is porting, as Noelle says, people who kind of understand the private placement market, but then people who also understand securitization, indentures, and things like risk retention that normally, classic private placement investors wouldn't see and wouldn't necessarily appreciate as much. And we're kind of melding those two things. And that's frankly, we were talking about this today, that's certainly still in process. And I think, we're thinking about convening a panel, maybe at the ACIC on actually producing officially that form and having a form of their note purchase agreement that assumes that there's going to be a separate indenture and therefore, ports a lot of the provisions there.
And we talked about the relationship, so when I was at a law firm, I was a 144A. That's all I knew. I actually never did private placements until I joined Nuveen. I know how indentures work. I know the difference. When you're a private investor, there are places that you want privity with the issuer where otherwise you would normally go through the indenture trustee. Also, the issuer's material affiliates who are involved in the deal, we look at that for indemnification, some of the material reps and material covenants. And then we will refer to the indenture for all the other stuff. But there's a lot more differences, to kind of talk about. You can't forget about the relationship. So I think the biggest, most important difference for issuers to think about is that the investor group is a phone call away. Usually in private ABS, it's one or two or three investors. So if something goes wrong, it's not the 144A amendment and consent process. It's picking up the phone, calling, and have a conversation. But again, the other difference, I said this again, but it's incredibly important to me and the team, is we are there at all parts of the transaction, before pricing and negotiating documents, when our investors provide their capital, and then when something goes wrong. So my job in the legal department is to protect downside risk. So the business guys analyze the cash flows, manage the relationship with the issuer, know that the deal is solid. I have to make sure that we've created a structure that protects our investors if things go south. So sometimes our triggers might be a little bit tighter than in the 144A space. That's not to create a foot fault. That's to make sure that we're fully informed so that we can work with you. There's less liquidity in private ABS. We are very aware of that. We are typically a buy and hold shop. Can't guarantee that, obviously. But when we're underwriting, when we're looking at structures, we believe that we are going to be with the issuer for the life of the deal. And so we have to be fully informed about what's going on. And that is kind of our focus on the downside risk. But I will say, creating a relationship, the dynamics can be interesting sometimes because we are creating a long-term relationship. There's direct interface between the issuer and the investor. We don't have the placement agent who's kind of, having the conversations. They might be there, they might be involved, but we're also there. And so we have to bear upon our issuers to know that they can trust the relationship that we are creating. But again, we just need to make sure that the structure works for their needs, as well as our needs to be able to stay informed and work with them if things don't work out as expected.
Yeah, and that's just to highlight one point there. That's a key point that, when we have our issuer counsel hat on and we're advising issuers sometimes, should they do a 144A or should they do a 4.2? Especially for smaller, closely held first-time issuers, it can be a lot easier to do a 4.2 because you know you can pick up the phone and call your contact at the investor, and, you know, let's say something got structured wrong in the deal. Well, 6 months later, you can make a phone call, you fix it. You know, instead of having a 144A and having to run a consent solicitation, et cetera, et cetera. So that's a big point for a number of folks, and especially for the smaller issuers or people who are just getting their feet wet in securitization, can be a huge value add as well.
But don't forget, issuers can definitely be 4-2 for life.
Yeah.
Yeah,
Slogan
Scott,
for
I
that.
would think that's a selling point at your platform too, right? That, you know, if your borrower issuer has an issue, they can call you up and deal with you directly versus large securitization.
Look, yeah, that part of the reason that people come to us is we're not a bank. We have one investment committee, and that's where we go to make decisions. So to be honest, a lot of the deals that we're doing in specialty finance lately is we're going head on with the banks and just providing a little bit more flexibility for a little bit more price. And the honest answer is both sides win. There were 2 press releases recently. We financed Southern Management and also Ag Resources. These were deals that were financed by banks. It's just our creativity made it better. And again, when things go sideways, they have one credit committee that we have to go talk to do an amendment, not 15 committees, not a regulator, and not a business that changed where it wants to play constantly.
Now, Scott and Noelle, you talked about underwriting. How important are ratings in these, you know, types of transactions? I know certain types of investors, it's critical. How important are the ratings? And if you're getting something rated, do you typically handle that process yourself, where you're interfacing with the agencies? Do you have someone else do it?
I can speak for Ares. The answer is for insurance relationships where we're managing insurance money, ratings are critical. And so the answer is they need it. If we're buying off the desk, then the banks do it. But if we're structuring ourselves, we get ratings done, and it's not about the rating. No one in the shop thinks the rating speaks to what we underwrote and what the risk is, but it's part of the process.
He said it.
Yeah, I mean, I think that is, kind of what we've seen as well as, you know, the ratings for a lot of, particularly the insurers are critical. But it's also because people have gotten a greater facility at getting them, it's opened up, you know, a whole universe of additional opportunities. And you know, we have lots of clients that have kind of dedicated groups within their firm that just structure ABS paper for their insurance company affiliates or investors. And
Yeah, the danger that I've seen is, I think that's great when people do it for the ABS market. It's when you're seeing issuers try to convince the ABS issuer that the unsecured OPCO loan that got the BBB rating is the same way to think about the B class in securitization, and I think they're completely wrong.
Yeah.
But people are buying it today.
Yeah, and I was going to say that too. I mean, we're guided by the needs of our investors, which are largely insurance companies, and so we have a regulator. We have to follow what our regulator is saying, and some of the sexier products that we've seen in the market, maybe it passes muster today, maybe it's not. And the rating is important to our investors because that's their capital treatment. And if the rules change for a regulator, then it might get the capital treatment that we want today, but not in 2 years. We monitor that risk, and we're following what those regulators are doing.
got it.
John, can I make one rating
Yeah.
point? So one other rating point that's relevant to the 4.2 market is it is possible to get not, unpublished confidential ratings. Obviously if you do a 144A, you're going to have a published rating. There's going to be a pre-sale report. So the whole world's going to know what your deal is and how your deal was structured and how it was done. There's a lot of issuers out there, we've seen this recently in some of the oil and gas deals, who don't want to do a 144A yet, and they want to be able to have their structure be a little more confidential. They don't want to have, the structure and all the counterparties disclosed immediately. So you can still get it rated for your investors. You just don't have to get a public rating.
Yeah.
That's private letter rating, but that's one of the places I want privity. And I do need, again, for my investors, a covenant to maintain that rating.
I would say it actually also depends on what the issuer's end goals are as well. And so what we've seen already in some of our smaller issuers and originators is that they have an eye towards getting bigger. And so a rating actually gives them credibility in that instance. It may not be exactly what they want at the moment, but they have and can demonstrate a path towards being investment grade down the line. And so having that history there of the rating over and over time with the various different securitizations that they do is actually very advantageous for them as well.
Now, Nelson, there's been a tremendous focus at this conference, as well as others, on new technology and how new technology might increase efficiency and lower cost in the securitization process. One example of a new technological innovation that could facilitate growth has been blockchain. Can you explain to us what that is and discuss how this is being used in some private ABS, like whole business securitizations?
Yeah, sure. Very timely. Actually, that we are probably the first one to get a rated securitization with a digital asset element to it. So I think hopefully a lot of you guys are familiar with the concept of blockchain, but it does break apart itself into various different themes, I would say. It could be, there's a mining element to it, like what Bitcoin has. There's decentralization, where all of these computers in the world have to agree on the calculation. And there's also immutability, which is that something can never be changed. And so I would say for financial services, and especially for the securitization in the ABS market, decentralization and mining are probably not that important, but immutability actually is. And so the concept of having data that can never be changed is really important for when we're looking at loan tapes, when we're doing underwriting, and all these various different things, whether you can trust the data or not. And so for what we're doing, we're kind of taking a very pragmatic approach towards implementing concepts of blockchain technology into this. And so all the data that we collect, whether you're a small originator or a public company, like the one that we just did, it doesn't really matter, but it all gets recorded into our immutable database. It's actually Amazon's, so hopefully pretty trustworthy in the grand scheme of things. Jeff Bezos maybe not, but we'll say that. But outside of that, the actual digital asset that we issue for this rated securitization is something that is just designed to bring extra transparency. And so no one's going to say no to transparency. No one's going to say no to being able to actually have a digital record of who owns what at any given point in time and who's responsible or who's going to be eligible for the distributions that come out of a transaction. And so there's definitely elements of blockchain technology that I think are very important, and you'll see it start to be implemented in the ABS space over time. But it's very much a progressive, slow but steady pace towards getting more of that implemented in every single step of the process. For us in particular, I think the next phase for this, beyond just issuing a representative transaction through a digital asset, is going to be data verification, right? So right now we have monthly collection reports that come out. There's no way to verify whether that data is actually accurate or not. And so our ability to kind of step in and write that data, because we are integrated and hooked into the originator and the lender from a technological standpoint, means that we can verify the cash flows actually happened and cross-reference that with the collection report, and then ensure that all of that is actually accurate and as presented, and it's all immutable and can't be changed. And so there's a lot that we're pushing on that front to be pretty progressive there, and we hope to be at the forefront of implementing new technologies into the securitization market.
Thank you. And I think you're right. I mean, I think you'll continue to see blockchain kind of proliferate in the ABS space. Last question for the panelists. If you could describe the next 12 months in the private ABS space with one word, what would it be? And let's start with the other end this time. Mike, we'll start with you. One word to describe the private ABS space in the next 12 months.
Do I get to describe the word, or do I just say the word?
You're free to do both.
I'm just going to say flexibility. I think, look, we're looking at a busy year. We're looking at a lot of macro events. As noted, who knows what's going to go on with the election or the capital markets this year. And so at the end of the day, though, people are still going to need capital, and they're going to need it from creative sources. And I think the more flexible people can be, the better. And I think the private placement market's ideal for that.
Noelle?
Busy. Our investors have a demand for this product, and we have been working hard on building the relationships to source it. We want to put our expertise to work. Had a great year last year, and we're expecting it to be bigger, even bigger this year.
Scott, they're setting a high bar. Flexible, busy. But I agree with both those. I mean, I think it's,
tight spreads. Tight spreads, the market's going to stay competitive. I think what most people don't recognize is just the insanely high amount of private capital that has been raised between private equity, private credit, private asset managers. And it's a game changer that people haven't really thought about. You think about how many people now have locked up money to invest in this world, that these businesses didn't exist through crises before. So when the crisis hits, they may still have locked up money for 3 more years.
Yeah.
So we're going to be in a competitive environment for a while. My view is we're just going to constantly see different shocks from different end markets at different points that people aren't going to be ready for.
Yeah, no, I agree with you. And I think, future, Vegas conferences will have several panels, devoted to this, because I think it is growing. Nelson?
I think cautiously optimistic. And so I think, the rule of thumb in this instance is don't reach for yield. I think you should never lower your underwriting standards just to get more out there. There's a lot of cash waiting to be deployed into these opportunities. But the truth is that if you start to widen that credit box, it's going to hurt you in the long run. And so whatever's coming, just be careful what's out there. And when it turns, it's going to turn pretty quickly, and it's going to turn pretty hard. And so don't be caught out in that instance.
Well, thank you. And, we have a couple of minutes. If anyone had questions, we can open it up. If not, I want to thank our panelists and thank everyone for coming.